What is a qualified dividend? Have you ever wondered how dividends can impact your taxes? Today, we are going to break down what a qualified dividend is and why it matters in the world of accounting and taxes. A qualified dividend is a specific type of dividend payment that is taxed at a lower capital gains tax rate instead of the regular income tax rate. This distinction is important for both individuals and businesses when it comes to reporting and taxation. To qualify as a qualified dividend, certain criteria must be met, according to the Internal Revenue Service. First, the dividend must be paid by a United States corporation or a qualified foreign corporation. A qualified foreign corporation is one that is either traded on United States exchanges or is based in a country that has a tax treaty with the United States. Another key factor is the holding period. To qualify, a shareholder must hold the stock for more than 60 days during a 121-day period that starts 60 days before the ex-dividend date. The ex-dividend date is the cut-off date to own the stock in order to receive the next dividend payment. Now let's talk about tax implications. Qualified dividends are taxed at long-term capital gains rates, which are generally lower than ordinary income tax rates. As of 2024, these rates range from 0% to 20%, depending on the taxpayer's income level. In contrast, ordinary dividends are taxed as regular income, with rates that can go up to 37%. This difference makes it essential to identify qualified dividends for accurate tax reporting and planning. From an accounting perspective, dividends paid by a corporation are recorded in the general ledger as a reduction of retained earnings. However, whether a dividend is classified as qualified or ordinary does not directly affect the corporation's financial statements. This classification is more relevant for shareholders when they file their individual tax returns. For businesses distributing dividends, it is necessary to provide Form 1099 dividend to recipients. This form specifies the portion of the dividend that is classified as qualified. Understanding qualified dividends can help shareholders optimize their tax liability. For example, holding a stock for the required period ensures eligibility for those lower tax rates. Accountants and tax professionals must verify holding periods and payer eligibility to ensure accurate reporting. Misclassification could lead to penalties or risks of an audit, which no one wants. Key terms to remember include the ex-dividend date, which is the date by which an investor must own the stock to receive the declared dividend, and the holding period, which is the time a shareholder owns the stock. Also, keep in mind the importance of Form 1099 dividend, which reports dividend income, including qualified amounts. By focusing on these criteria and their tax implications, individuals and businesses can manage dividend-related income and liabilities more effectively. Understanding qualified dividends is a smart move for anyone looking to navigate the world of taxes and accounting.